Well, I was very impressed with the way the market rebounded today. In fact, all major indices climbed off the canvas to close higher. So if January is a barometer for the rest of the year, well, it looks like 2018 could be gangbusters. The S&P 500 posted its best January since 1998, rallying over 5.6%. Slightly less than the Dow, which was up almost 5.8% this month. Now, the biggest winner, of course, for 2017, well, same thing so far for 2018, the NASDAQ, and it's been led by those high-flying, modern-day horseman stocks of the tech world. But I got to tell you, we could see the miraculous rally interrupted here just a little bit. Earnings are coming out, and let's face it, these stocks have a Herculean task to try to justify their recent parabolic moves. To that note, after the close, Microsoft posted a beat. They beat the street by 10 cents. And Facebook, they actually came in line with better numbers, 26 cents better than expected. Shares of Microsoft promptly swooned. Facebook was down, but now it's beginning to soar higher in after-hours trading. And, of course, tomorrow we're going to get results from Apple, Alphabet, and Amazon. Meanwhile, it was the last FOMC under Janet Yellen, and while no official communique was sent out, no action was taken. There was a sort of a communique that we're going to get at least 3 interest rate hikes this year. That sent the market into something of a tailspin. Now, conventional wisdom holds, though, that if the Fed can just stick to 3, fine. But some people think if it's more than 3, that could be a disaster for the market. So the big question now, have we passed the Goldilocks period of the stock market? I want to bring in now 2 of my favorites to discuss. Kyle Harrington is with us, founder of Harrington Capital Management and co-founder of HBA Sports Academy, and David Nelson back as well. Hey, Kyle, are we past that Goldilocks period? Are we actually going to be victims of our economic success?
Well, listen, I mean, with wages up and bonuses being handed out, manufacturing numbers, we heard a lot about this last night. The markets, have run up significantly. And I think that, probably this year in 2018, there will be Fed interest rate hikes. You saw the market pull back a few days ago, but then rebound very nicely today. I think that, look, we're going to see how these numbers fall out. I think the summertime is going to be a very interesting time. If there continues to be long-term sustainable jobs added to the marketplace, not just temporary jobs, I think that there'll be interest rate hikes, and I think the market will pull back a little bit.
David, it just seems to me that the Fed, if they do hike rates, particularly just 25 basis points move, because the economy is doing pretty good, that's what they're supposed to do, and the market should not overreact. If it does, what would you do?
Well, you step in there and buy, but I'm fully invested, so I don't have much cash to go in on that. But I'd be careful here because, the calculus could change. If you've been seeing rates climb pretty dramatically in the last couple of weeks, rates going up for the right reasons, that's great news. But if it happens too fast, it could change the calculus for the Fed. And, despite the benign reaction in the markets, today, it was Boeing, and underneath the surface, I had a lot of red on my screen. Healthcare was getting hit.
So to that point, though, is the Fed reacting to the bond market, or is the bond market reacting to the Fed? And are you really concerned? I mean, I know you're not concerned with 3%. To your point, maybe the degree in which it's moving, the speed in which it's starting to move.
It's the speed with which it moves, and it's the direction with which it moves. At some point, the long end of the curve becomes competitive for the stock market. We're a long way from that, and right now the economy is pretty strong. I'm more concerned about the economy and jobs and the underpinnings of some of the stocks you just mentioned.
Well, Kyle, to that point, I would be shocked to see the Fed step in just as things are turning around. For instance, home ownership. First time it's gone up year over year since 2004. Wages. This is the best wage number. Last quarter was the best wage increase since the Great Recession began. We're just now turning the corner and gaining momentum. Would the Fed be nuts to snuff that out?
I think that if the Fed jumps in here and, say, for example, in the near term raises rates 100 basis points, I think it's a mistake. I think that we need to be very careful about how this process happens, which is why I think there was the notion of outlined that there'd be 3 rate hikes throughout the year. I think the Fed needs to look at this marketplace and inch its way in the right way. The market is going the right way. Just be very careful about how quickly you raise interest rates.
All right. I guess the moral of the story, boys and girls, is buckle up. Thank you guys both. Appreciate it.